Welcome to Business Basics Hub. You know, we absolutely love taking those big, complex business concepts and breaking them down into clear, actionable explainers. Today, we're talking about limited partnerships, or LPs. What they are, why they might just be the secret sauce for your next venture, and exactly how to put one together. Let's get right into it. Now, real quick before we dive in, just a standard reminder. This explainer is for general educational purposes only. It's not legal, tax, or financial advice. Every single business is totally unique, so definitely chat with a professional about your specific situation. All right, here's our roadmap for today's explainer. We'll cover what an LP actually is, why LPs matter to you, a simple guide on forming your LP, and finally, the common beginner mistakes you absolutely need to avoid. So part 1. What is an LP? Let's get the basics down. A limited partnership, or an LP for short, is actually one of the oldest business structures here in the US. I'm talking all the way back to the 1800s. At its core, an LP is a business structure that needs at least two people. One general partner who actually manages the business day to day, and at least one limited partner who simply invests the money. Unlike a regular partnership where everybody's the boss and everyone takes on all the risk, an LP deliberately splits things up. It creates a neat little wall between the folks running the show and the folks funding it. Think of it like a road trip. The general partner, they're the driver. They're behind the wheel, making all the navigation decisions, and because they're driving, they take on the risks. This means they have what we call unlimited personal liability. If the business hits a pothole or gets into trouble, the general partner's personal assets, like their house or their savings, are totally on the line. On the flip side, the limited partner is chilling in the passenger seat. They're just a passive investor. They chipped in for gas to make the trip happen, but they literally do not touch the steering wheel. And because they aren't driving, their risk is completely capped. They can only lose what they originally put in. Their personal assets, 100% protected. Moving on to part 2, why LPs matter. Here are the core benefits for small business owners. So why go this route? Well, LPs offer this incredible mix of safety, control, and tax perks that you definitely want to take advantage of. First off, as the manager, you get to keep 100% operational control. You don't have to go poll your investors every time you make a decision. You just run the show. Meanwhile, your passive investors can sleep soundly knowing their personal piggy banks are totally shielded from any business debts. And financially, LPs bypass the dreaded double taxation that hits a lot of corporations. The business itself doesn't pay federal income tax. Instead, the profits just flow right through to the partner's personal tax returns. Plus, and this is a big one, limited partners don't pay self-employment tax on those profits because the IRS doesn't see their passive income as earned wages. It's basically the perfect setup to attract people to fund your vision. All right, part 3, forming your LP. Let's look at the step-by-step guide. Now, unlike a regular partnership, you can't just shake hands on a porch and call yourselves an LP. You've got to make it official with the government. Step 1, choose the state where you'll operate. Honestly, it's usually easiest to just register right in your home state to keep things simple. Step 2 is picking a business name. Just remember, it has to include the letters LP or the words limited partnership so the public knows exactly what they're dealing with. Step 3, designate your partners. Get crystal clear on who the general partner taking the operational risk is and who the limited partners bringing the cash are. Step 4 is absolutely crucial. Draft a private partnership agreement. Seriously, do not skip this. It privately maps out exactly what everyone's role is, how profits get split, and what happens if someone wants out. And step 5, file your paperwork. This is usually called a certificate of a limited partnership. You file it with your state's Secretary of State office and pay the filing fee. Okay, halfway there. Step 6, appoint a registered agent. This is just a person or a company with a physical address in your state who's available during normal business hours to catch any official, legal, or tax mail for the business. Step 7, grab an EIN from the IRS. Think of this employer identification number as basically a social security number for your business. It's totally free and you can grab it instantly online. Step 8, open a dedicated business bank account. You'll use that new EIN and your state paperwork to set this up. Step 9, get your local licenses and permits from your city or county so you can legally run your specific type of business. And finally, step 10, stay compliant. Most states require you to file a quick annual report and pay a yearly fee to keep your LOP in good standing. So put a big circle on your calendar for that one. Which brings us to part 4, common beginner mistakes. You'll definitely want to watch out for these traps. The biggest trap by far is something called the control rule. Remember our car analogy? Well, if the passenger suddenly leans over and tries to grab the steering wheel, things are going to go very, very bad.
If a limited partner starts getting involved in the daily management, say hiring employees or signing contracts, bam, they lose their liability shield entirely. They're treated just like a general partner and their personal stuff is suddenly at risk. They absolutely have to stay passive. Another massive mistake? General partners forgetting that their own personal assets are on the line. Actually, scratch that. It's so common that a lot of pros will set up an LLC, a limited liability company, to act as the general partner instead of a human being, just to build in an extra layer of safety. Third, never ever mix personal and business money. If you buy your personal groceries with a business debit card, courts can easily pierce that protection. Keep those funds strictly separated. And lastly, skipping a custom, professionally written partnership agreement. Honestly, that's just a recipe for disaster. Vague handshakes lead to wildly expensive arguments later, so spend the time and money to get it in writing right up front.
As we wrap things up today, just one more quick reminder that this explainer is for general educational purposes only and not legal, tax, or financial advice. Laws and requirements vary pretty heavily from state to state and person to person, so always consider chatting with a qualified professional for guidance that's specific to your unique business. I really hope this helped you understand exactly how a limited partnership works and why it's such a ridiculously powerful tool. If this explainer cleared things up for you, do me a favor and give it a like, and share it with a friend who might be starting a business too. Also, don't forget to subscribe to Business Basics Hub and hit that notification bell so you never miss out when our new explainers drop. We've got plenty more simple, no-fluff guides coming your way. But before you go, I want to leave you with a thought. Are you currently carrying unlimited personal risk in your business right now that a simple LP structure could literally solve by tomorrow? Let that sink in. Thanks so much for learning with me, and I'll catch you in the next explainer.